Has the recent market volatility caught your attention? Maybe it's caused some worry and some stress for you. Hopefully not sleepless nights, because it has been a bit of an interesting week in the markets, that is for sure. So on the program, that's going to be, as I look at my notes here, pretty much our sole topic, because it is certainly a very timely topic. We're going to tell you what we believe is the root cause of some of this volatility and what you should be looking at right now in your portfolio, along with 3 different strategies that you might want to consider employing to take advantage of what's been going on in the markets of late. So welcome on in to this week's edition of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries. Over the course of the summer, you've had an opportunity to meet and hear from them, and so we look forward to having them continue to join us as the weeks unfold ahead, and we maybe shift to fall. I don't know. It's still probably dead of summer still, but we will have them join us regularly on the program going forward. They're part of the team at Nelson Financial Planning, where we help you improve your life with a successful and cost-effective financial plan. So I guess it's only appropriate that we live in Orlando, and this show comes to you, besides its podcast channels, which of course reach all over the world. We are live every Sunday morning on a variety of radio stations here in Central Florida. And appropriate enough, we're located here in Orlando, because if you were watching the markets every day this past week, you would have thought that you were riding the Hulk or Rip Ride Rock and Rollercoaster, or pick your particular theme park roller coaster, because that's pretty much the only way to describe what went on this past week in the markets. Monday was the big headline day, 1,000-point drop, bounced around for the next couple of days, and then Thursday it was up 700 points. Folks, that is the very definition of volatility, right? I mean, these dramatic swings in the market. And, you know, we've been doing this for 25 years, so certainly we've seen our share of market volatility and tough times. 2001, 2008 sort of really come to my mind as some of the tougher periods of time. This time of year, we mail do a mid-year mailing, an actual letter in the mail through the U.S. Postal Service. Yes, we're still kind of old school like that. And ultimately, we do that. We do one in January. We do one typically here in August. And we announce our kind of fall lineup of client events and sort of give perspective of where things are market-wise. So if you are a client of Nelson Financial Planning, then you probably got that letter yesterday, or maybe you're going to get it tomorrow, Monday. In it, we said to expect higher volatility in the weeks ahead. Wish I hadn't been quite so right on that, because volatility ain't fun and certainly stresses people out. But historically, this is in line with typically what you would see, setting aside all the other headlines that are happening out there economically and geopolitically. This is historically sort of the pattern of what you would expect to see in the weeks leading up to a presidential election. Look back to those prior presidential election years, you typically see that uptick in volatility, and certainly this year, based on what we've seen over the past couple of weeks, no exception to that. But understand that volatility is normal, and of course, if markets went up smoothly every single day, well, then everybody would do it, right? But not everybody does do it, and many people hop in, hop out, only to significantly undercut their investment returns over time. We'll give you the stats. We've given them many times before on the program. Past 100 years, just to give perspective on how normal volatility is. Over the course of the past 100 years, you see 5% declines or more 3 times per year on average, 10% declines around once per year. Declines of 15% or more typically happen every couple of years, and declines of 20% or more, those happen as frequently as every 3.5 years if you look at the history over the course of the past 100 years. And it's that volatility that, based on those statistics, right, pretty normal. But at the end of the day, that volatility creates so much human emotion that it can cause us to make reactionary decisions and quickly get off track. Because to underscore how quickly you can get off track if you're making a reactionary decision, one of the things that I think people miss is that many of the best days in the market, the best single days in the market, are actually clustered around some of the single worst days in the market. Take this week, just for example. Monday down 1,000 points. Thursday up 700 for the Dow. That day, Thursday, was the single best day since 2022 for the market. So you often see these bad days, but you also see the good days clustered around them. And the reality is those good days fix a lot of damage that happen on the bad days, because usually those good days are strong days in terms of sort of those snapback sort of recovery days. And that's why the standard advice is to kind of leave it alone. But, oh boy, right? That's kind of unsatisfying, right? Against the barrage of negative news, Fed speculation on where they're going with interest rates, presidential election, let's not forget. It can be somewhat unsatisfying to come to the conclusion of, hey, I'm just going to leave this all well enough alone. But history says that that's your best course of action at the end of the day. And but when you think of that, though, I think there are some things, particularly in light of any period of volatility, that you can do and should be doing right now. And before we get to that, we got a couple of specifics that we're going to share with you here this morning on the radio program. I want to spend some time talking a little bit about what we see as sort of the root cause of this current spate of market volatility. And certainly the economic data that's coming out that's kind of bouncing all around in terms of employment levels, presidential election, the Fed, will they, won't they, when are they going to cut interest rates? All of that is certainly a factor, but we think that there is a root cause of all of this that isn't getting as much conversation as what we think it should. And that's really a kind of a key thing to be thinking about as you start to digest what's going on in the market right now, what's going on with your investments. So when we get back from this break, we're going to talk specifically about what we think that the real kind of root cause is that's really sort of accelerating the volatility out there, and then give you 2 key things that you can do right now as it relates to your investments to just make sure that you're in as good a shape as you can be. So that is all coming up here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So on this week's program of Dollars and Cents, we thought it only appropriate, given the headlines of the past week, to talk a little bit about market volatility. This may be one of those shows, and doesn't happen very often, where we focus on a single topic because it is so timely and it is so important that people sort of understand all aspects of the particular topic. You know, normally on the program we talk, we usually have 2 or 3 different topics. This one, we're just devoting straight to market volatility, what went on this past week. And on this segment, we're going to talk about what we see as the root cause of sort of this uptick in volatility. No question, economic data is kind of bouncing around all over the place. The will day, won't day in terms of the Federal Reserve raising or lowering rates. And then, of course, let's not forget that fabulous presidential election. But there's more to the story. And that's what we're going to talk about in this segment, along with giving you 2 specific things that you want to look at right now when it comes to your investments. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs. Also, a top 25 financial planning podcast on the big wide world web. Check us out on your favorite podcast channel. Any trouble finding us, or for that matter, if you want to learn more about who we are, go to our website, nelsonfinancialplanning.com. There you'll get all of that information that you could possibly imagine getting, all there in one spot on our website at nelsonfinancialplanning.com. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So the root cause behind a lot of this volatility is certainly something that we've been talking about at length on this program over the course of the past couple of years, and something that we've been warning you to sort of be careful about. And that's really this notion of market concentration and how much a very small number of companies has in fact been driving the overall performance of the market. And in a way, it's sort of creating this false sense of across-the-board performance in corporate America, right? When we think about an index, or we think about the S&P 500, right? 500 companies. That's what it is. That's the definition of it. But it's market capitalization weighted, which means that the bigger you are, the more you're going to drive the performance of that particular index. So we've heard the names FANGs, we've heard the names Magnificent Seven. The reality is when you start to parse the data, it's actually kind of staggering how much that concentration is. In 1999, peak of the dot-com bubble, the 30 largest companies in that S&P 500 index accounted for 42% of the total amount of that index. Okay? 99, top 30. Remember it very well. Maybe you do too, but I was in the business then, and I remember it very, very well. It was right at the beginning of my career, and those things that happen at the beginning of your career really do stick in your mind. And so the 30 largest companies, 42%, right? Today, well, if you look at June 30th, obviously the numbers have shifted a little bit as a result of the volatility over the past few weeks. June 30, the top 30 companies accounted for 53%. So in a lot of ways, you have a market that is more concentrated, or 20% more concentrated than it was at the height of the dot-com bubble. We have some concerns on that, and so should you. I mean, the reality is that the market consists of 11 different sectors. But one of them, information technology, just that single sector, accounts for 40% of that market weighting. So think about it this way. If you were to seek out a diversified individual stock portfolio, would you put 40% of what you're investing in a single sector of the economy when there's like 10 others? Probably not. But unfortunately, when you own an index fund, that's exactly what you have. To put it further into perspective, the 3 largest stocks, Apple, Microsoft, NVIDIA, as of June 30th, represented over 20%. So three stocks, over a fifth of the performance of the S&P 500 was attributable to just those 3 stocks. Those 3 stocks basically provided performance that was equivalent to the bottom 362 companies of that S&P 500. So does that sound diversified, or does that sound concentrated to you? And by the way, we're going to let you in on a little secret, okay? And it's worse, or the concentration is worse than some of these data points that we're giving you, because what you might not realize is that the folks at Standard & Poor's, the S&P part of the S&P 500, constantly are adjusting not just the companies that are part of the index, but they're actually adjusting the particular classification that a company has to adjust for when a sector winds up being outsized in terms of its weight or its contribution to the index. We can give you two examples. In 2018, the S&P 500, or the Standard & Poor's people, decided to recategorize from the technology sector to the telecommunications services sector, both Google and Facebook. So the kinds of things that happen that you may not realize when you recategorize a company from one sector to the other, and you're doing that, as Standard & Poor's does, to make sure that you're not getting really crazy overweight on a particular sector, well, that's kind of like gaming the system, if you think about it that way. But that's what happened in 2018. And then as recently as 2023, both Visa and MasterCard shifted from technology to financials. So you can argue that they probably should have been in financials all along. But let's face it, Visa and MasterCard, certainly very technology-oriented types of companies. All of that done to sort of keep a lid somewhat on a particular sector of technology becoming an outsized weighting in the overall index. So that's what's happening. So what can you do to get to the bottom of all of this? Two things immediately spring to mind, and both relate to our fundamental advice that we give out on a regular basis on this program, which is know what you own. Know how you are investing your hard-earned dollars. Know what you own when you make an investment. And I want to break that down into two parts. So these are the two things that you want to be looking at right now in your portfolio. Number one, know what sectors you own and be careful about what companies are categorized in each. Is your portfolio 40% in information technology? Is it? Well, there's 11 sectors of the economy. So that's number one. Look at that sector allocation. Number two, look at the specific holdings. A lot of funds these days will own a lot of the same companies, because a lot of the performance in the market has been generated by a short handful of companies. So know what you own. How much do your top 10 holdings in your portfolio actually amount to in your overall, what's supposed to be a diversified portfolio? It shouldn't really be more than 15%. Okay, so you look at the top 10 holdings, and if it should be around 15%, preferably less. But for many these days, it's 30% or 40%. And so the current market volatility is going to affect your portfolio a lot more than one that is more diversified. The current volatility is going to affect you disproportionately. And certainly seeing that, if we look at the numbers, because we look at these numbers every day, in terms of the relative performance just over the course of the past 2 weeks. So in our office, that's where we share that information with our clients by running our Morningstar X-ray report. So if you're a client, you know what these look like, but basically they look behind the curtain of what you own, funds, ETFs, indexes, individual stocks, and break it out based on the sectors and also the top 10 holdings. So pretty interesting look. And that's one of the reasons why this summer we have been advertising that we will do for free an analysis of your portfolio. So if you want to take advantage of that and have us run that concentration report and risk analysis of your portfolio, visit our website, nelsonfinancialplanning.com. So if you missed that last segment, let me just quickly recap it here at the beginning of this segment. The two things that you really should be doing in terms of taking a look at your investments is, number one, get a very good understanding of what sectors you actually own inside your total portfolio. And number two, what individual companies then that you own. You should be able to look at the top 10 and look at how much of those are a portion of your portfolio. If it's more than 15% or so, you probably want to look a little bit harder, because you probably are much more concentrated than you should be. As we were mentioning before the break, that's why this summer we've been offering a free diversification and cost analysis, where we take your information and we run it through that Morningstar software that we have that ultimately creates an X-ray that really does break down what sectors you own and what individual companies you own as a whole in that portfolio. So if you want to take advantage of that offer, make sure you go to our website, nelsonfinancialplanning.com, and there you can schedule a absolutely free conversation. As you know, if you're regular listeners to the program here on Dollars and Cents, when you come in for that free conversation, we also give you a free copy of our book, Next Gen Dollars and Cents, holding it up for the audience on YouTube. And ultimately, so it's kind of a win-win, if you will. So make sure you check that out on our website and schedule that free conversation at Nelson Financial Planning. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. This segment of the program, we're going to talk about now, sort of pivot and talk about some other things besides knowing what you own that you can do in light of the recent market volatility, and really to perhaps use it to your advantage, because in some cases, market declines do present an opportunity to do some smart things with your money. So we're going to give you three specific ideas here in this segment of the program in terms of how you might use market volatility and market declines actually to your advantage. So the first one on the list is unfortunately one that I think is getting overblown in today's world, but it is a better option when you have a period of decline, and that is Roth conversion. So generally, not a big fan of them because, the internet's just completely recommending that across the board. So that's probably another good reason why we're not particularly, if the internet's recommending it in spades to do it, chances are that's not the best possible advice. It's basically an election to, pay your taxes now rather than later. And when you do that, if you're going to do that, you really got to run the numbers to make sure that you don't have any unintended consequences like jumping up your tax bracket or making your Medicare payment, your Medicare premium jump up because of the income adjustment that happens when it comes to those Medicare premiums. That's why anytime we're having these conversations with clients, we actually run an actual tax projection at the office. So our tax folks, Kristen, who's a IRS, who's a CPA, Christina, who's an IRS enrolled agent, part of the tax team at Nelson Financial Planning, that's a part of certainly what they do. But when markets fall, if you think about it, the tax bill for a conversion also goes down, right? So here's the example. So if back on June 30th, you were getting ready to convert 50,000 from IRA to Roth. Reality is that value might be 45,000 today. So the process of sort of converting those basically same number of shares that are just down in value actually results in a lower tax bill for that conversion. So some tax savings on that conversion that simply weren't there a month ago, if you think about it from that perspective. perspective. So that's concept number one. Again, caveat there, make sure you run the numbers, make sure that you really do look at what the tax implication is. But if your account has gone down in value and you do the conversion, then you're converting the same amount of shares, but the tax implications are less. So that's option one. Number two is an oldie but a goodie. It's the concept of tax loss harvesting. And this works when it comes to like something that is underperforming, something that's gone down in value. The caveat here is it only works in after-tax accounts. It doesn't work in retirement accounts. So let's give you an example on how this might work. Let's say in June, you spend $10,000 to buy a particular stock or a fund or whatever the case may be, and now the value is $9,000. Assuming you did that in your after-tax account rather than your retirement account, if you sell the stock, or in the case of a fund, you can exchange that fund to another fund, then you wind up taking that paper loss and converting it to a realized loss that then you can use on your tax return. Remember, on your tax return, you only get to use realized losses or realized gains on it. The imputed gain or something that's gone up in value or gone down in value, unless you create a transaction, then that's a non-reportable occurrence as it relates to your tax return. So when you do that and you sort of harvest these tax losses can offset capital gains. It saves money on your taxes. And then the other kicker of it is that to the extent your losses are more than your gains in that particular year, then you can use some of those losses, up to $3,000, against ordinary income. So way to further reduce your tax bill. And then if there are those extra losses, you get to carry those forward for future years. So it's not a use it or lose it kind of thing like so many other deductions. Capital losses you do get to carry forward until you have fully used them up. Caveat on these is always to watch sort of the wash sale rule, which basically prevents you from buying back what you sold. Otherwise you lose the ability to write that loss off, and there's like a 30-day window on that. That if you buy back the same thing within 30 days, then that loss winds up getting disallowed. The reality is as well that when we think about what's going on in the market right now, look, if you've had your investments since like maybe the beginning of the year, then you probably don't have a loss because the markets are still up decently on a year-to-date basis. So understand that if you're looking at this, have some perspective on it too, because anything that you've owned for a while, I mean, let's face it, the markets have been going up for a while. Anything that you're looking at, probably not going to have a whole lot of tax loss for you to convert and be able to utilize on your tax return. And then the third thing that we would suggest in terms of what you can do now based on kind of where the current market is, and this one is always kind of the scariest one, but it's taking some cash off the sidelines and actually investing it. There's over $2.5 trillion sitting in money market funds. And if it's money that you won't need until years in the future, then now might be smart to deploy some of that into longer term investments. Because the reality is once the Fed starts cutting rates, those great money market rates are going to disappear pretty quickly. And the reality is that if the market has declined, then you're able to buy your investments on sale. And who doesn't like a sale, right? I mean, the reality is that emotion takes over, and that same instinct you had to buy that shirt because you liked that shirt, well, you should have that instinct all the more if that shirt is now 10% off, right? Unfortunately, that often doesn't really apply to how we think about investing money, although it should, but human behavior and human emotion doesn't quite allow that. It's sort of a curious thing, if you will, how that behavior of humans works differently when it comes to your investments versus that shirt on the rack. We're going to take a break. When we come back, I'm going to give a little bit of a fine tune on this suggestion of maybe taking some cash off the sidelines to take advantage of market volatility, because I think this is a little bit of a fine tuning that you can do on this to maybe get a little bit more comfortable on this particular strategy. So we'll talk about that after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So here's the fine tuning, if we will, on that last suggestion that we were making in terms of how you can take advantage of the current market volatility and use that as an opportunity. The notion of taking some cash off of the sidelines and putting that into some longer term investments, assuming it's cash that is slated for that. Obviously, if it's money that you're going to spend in the next year or two, then you might not want to do that. But the reality is, for longer term money, and certainly when we think about the $2.5 trillion that's sitting in money markets today, there's probably a good chunk of that that's really kind of more longer term money, is to look at that as an opportunity, much like you would if you walked into a store and saw that a shirt was 10% off that you really liked. You'd be inclined to buy that shirt. Except it never really kind of works the same way. In 25 years of doing this, I don't understand why it doesn't work the same way when it comes to your investments. But it doesn't. And, that's the curiosity of humans, if you will. But one of the things that we suggest to sort of fine-tune that strategy, to sort of get some comfort with that, and history says that this works out relatively well over time, is that we suggest, particularly if it's money that's getting invested for the first time, right? Once you're invested, you stay invested. That is always going to be our fundamental approach. But for money that is getting invested for the first time, it's okay to think about it as more of a strategy to employ maybe over the next 12 months, maybe even over the next 18 months, and to ultimately use the notion of dollar cost averaging, which is basically, hey, I'm going to put in a certain amount of money on a regular basis every single month. And when I do that, and there's a lot of research that shows this, that it helps me smooth out the volatility in the market. So when you do that, I mean, look, the reality is that we don't know what's going to happen in the future. And certainly we're not going to wake up tomorrow and all of a sudden the headlines that we're all concerned about are all going to disappear. Although the presidential election will disappear, that headline will disappear after November. But the Fed rate conversation is always part of it. The headlines are always part of it. By doing that dollar cost averaging approach, if you've got cash and you're of the view, okay, Joel, you know what, you're right. Some of this is longer term money, but I'm just concerned about what's going on. The reality is by dollar cost averaging, putting a little bit of that in over the course of the next 12 months or the next 18 months until it's all invested, that's a great way to do that, to really help smooth out the volatility in the market. Because when the market's down, in the month that the market is down, right, you buy more shares. Market's up, next month, you buy fewer shares. Ultimately, over time, it does help to average things out, balance things out, so you don't get quite the same whipsaw that you would if you were just to dump all of the money in at one shot. So certainly something to think about. So let's see here. This has been, I guess, a bit of a irregular format for us on the show this week. Normally, as we said, we feature 2 or 3 different subjects, but certainly the behavior of the markets really drove the conversation and kind of what we wanted to talk about on the program this week. Market volatility certainly occurred in bunches. You don't need me to tell you that. If you saw any of the headlines, 1,000-point drop on Monday, 700-point increase on Thursday. All the other days also were, big swings as well. Certainly enough to give you a serious case of whiplash, probably more so, or more so than even riding one of those roller coasters down in a traction way. And so we wanted to just kind of take some time because we really did cover kind of a lot of thoughts here. So at the end of the show here, I, in this last segment, I want to just kind of recap where we are and what we've said to really reinforce some of the concepts that we're discussing on today's program. So if you missed any part of it, here's the key stuff here at the end of the program here on Dollars and Cents. Number one, market volatility is normal. As we said, we've been doing this for 25 years. We've seen some really bad times like 2001, 2008, but volatility is a normal part of the market. Remember those stats we gave earlier in the program? A decline of 5% or more occurs in the market on average 3 times a year. Decline of 10% or more occurs on average once a year. Decline of 15% on average occurs every 2 years. Decline of 20% occurs on average every 3.5 years. Volatility is normal, and that is certainly what you would expect to see, particularly in years where there's big headline events. And history also says that in these presidential election years, you do see an increase in volatility the closer you get to the election. Number two, the root cause of all of this, in our opinion, I think really can be traced to the narrowness of the market being driven by a small handful of companies, whether you call them the FANGs or the Magnificent Seven. The stock market has 11 different economic sectors, but information technology counts today based on weighting 40%. So if you're owning an index or basket of these overly popular stocks, you might not be as diversified as you think. Our 2 key takeaways for that, to address that, relate back to our fundamental concept that you need to know what you own when it comes to your investments. In this case, the details that you want to look are 2. Number 1, what sectors do you own and what percentages of your portfolio are in those particular sectors? And number 2, what is the specific holdings that you have if you look at your portfolio in the aggregate? How much are those top 10 holdings a percent of your overall portfolio? That's why, again, we'll make the offer again here in this segment. This summer, we've been offering a free Morningstar X-ray report that can really get into the details and let you see what those numbers actually are. We're offering that free to the general public. So if you're interested in taking us up on that offer, make sure you visit our website, Nelson Financial Planning, and go ahead and just schedule a conversation. And we're happy to run the analysis, no obligation, no cost. We'll also give you a free copy of our book, Next Gen Dollars and Cents, as well when you come in for that conversation. The third thing that we kind of chatted a lot about was that sort of the 3 things that you could do now to sort of make this market volatility work in your favor, right? Number 1, Roth conversion. Let's face it, if you're thinking about doing that, the tax bill is going to be lower, because if the account is down in value, then you're able to convert the same number of shares that you were thinking about converting when the market was higher. So that means then that your tax bill will be less for effectively the same amount of the conversion. The caveat, and it's a big one on here, there's a lot of hype out there about stressing Roth conversions. You really got to run the numbers. You really got to look at a tax projection. That's what the tax part of the team at Nelson Financial Planning does for our clients on a regular basis. So that's thing number 1. Thing number 2 is the notion of tax loss harvesting, which saves on your taxes. If you look at a fund or a stock or whatever it might be that's down in value from when you originally bought it, then if you sell it or you exchange it, you take that paper loss, you're able to then convert that to a realized loss that you can use on your taxes, thereby saving you money. Caveat, of course, is the markets are still up pretty good, even year to date, so you might not really have a whole lot of opportunity on that. And then lastly, thinking about bringing that cash off the sidelines. Market's running a sale, and I know that's hard to really kind of appreciate, but it is. But the fine-tuning on that strategy that we would give is the following. Because we don't know what the future holds, right? I mean, nobody does. And so if you dollar cost average invest that cash over a period of time, then that really does help to smooth out the volatility, so you're not experiencing quite as much whiplash as you might. So if you have questions about anything we talked about on the program, anything about market volatility, how is that impacting your investments? How is that impacting your retirement? Things like, what's the concentration in my portfolio? Or how do I take advantage of some of these strategies that we've talked about? Feel free to reach out to us. Visit our website, nelsonfinancialplanning.com. You can fill out the contact information there, schedule an absolutely free conversation to go over these details of your particular investment and financial situation. Or you can pick up the phone, call the office, 407-629-6477. We have live people that answer the phones, so give us a call during business hours, and we'll be happy to set up that conversation. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning. You've been listening to Dollars and Cents.